Hey everybody, this is Jose Blasco. We are about 30 seconds away before we start the session. Let's use this time for a quick sound check. I would appreciate if you guys can write a quick hello on the chat box. Just a quick message would do. That way I know you hear me and therefore we're ready to get started. Technology is on our side, which should be the case, but always good to reconfirm. I'll turn on my video stream as well, so that way I can say hi from the bottom right corner of the screen. How are you, my friends? Very good. I see sound is good. Wonderful. Perfect. So let's make it official. My friends, we are live. Welcome to the session. Today is January 14, 2021. We are getting together today to talk about futures, not futures, sorry for that, options trading. Well, it's all derivatives, but really, as the name of the session suggests, options give you options, isn't it? We have calls and puts, we can go long and short, and then we can do all sort of combinations of different options contracts, including contracts of different expiration dates and strikes and calls and puts and all combined. It's really an amazing asset to trade. So in that sense of diversity, we're going to be looking at opportunities which are directional, making money when markets go up, making money when markets go down, but also non-directional, making money when markets remain trading in a range, sideways if you wish. And basically what we like to do in our portfolios is to combine a few trades of each type. So no matter what happens, some trades profit, some trades lose, and the ones that lose less than the one that profit. And again, overall, then you create profits, you create consistency in how you collect such profits, assuming you do all of this the right way, okay? So one more message before we get started, which is the disclaimer. I'm gonna highlight it. Please go ahead and read it carefully. It's legal text, obviously, but it's certainly short and easy to read. At the same time, it is relevant because we are trading. Therefore, there is risk involved. The risk is actually monetary. And therefore, it is not a joke, okay? So if you're new to trading, just make sure you understand that. If you are experienced, you know that. Certainly a healthy thing is to be reminded, okay? Good. Everybody, the session is now officially introduced, so we are now jumping into our TradeStation to begin. Today, I want to have a quick message before we get started. So let me bring a text on the screen very quickly so we can read it together. Here we go. So this is an email that all of you should have received. And if you have not received such email, it's because you are not a member of the tradewithufos community, which is a shame. You should be, because it's free, right? So let's begin there. So if you are not a tradewithufos member, just get on our website, you click join, and the moment you click join, you will see that there is a free tradewithufos membership right here. So you click agree and join. You follow the steps, and basically you just need to input your data. There is nothing, no credit card, no anything, because as you can see, it's free. So just complete the steps, and now you are a tradewithufos member, so you receive our emails. And the one I want to mention today is the one we have on the screen, which is a special email because tomorrow we are running a special session that we noticed that not everybody is aware of, and we want to make sure you are aware of, and most importantly, that you use it correctly. My friends, it's all about trading psychology. December 2019, if I'm not mistaken, so it's over a year now, we had a very serious conversation here in the YouTube channel where you guys were asking for a lot of trading psychology support, which we added throughout the last year. But not many of you are actually using the resources the right way, or not even using them at all, which makes us think that maybe there's room for improvement in our communication and we didn't let you know properly, okay? So, bottom line, let me correct that issue by showing you the calendar. And I want to make sure everybody understands and realizes that on the Fridays, okay, we are running what we call Head Start sessions with Reynaldo, which are trading psychology sessions, okay? And of course, it is a bit complicated to run trading psychology sessions in the YouTube channel because we gotta talk, we gotta interact a lot, we need to talk about what are your problems. First, it's a public forum, so maybe not everybody is comfortable sharing the problems. On top of that, the YouTube channel always creates a little bit of a delay. and therefore it may not be that easy to have a back and forth type of conversation on the chat box. So in order to help, what we have done is that we're asking you in an email sent today that you respond to our email and stating what are your challenges, what didn't work last week when you traded, or this week, as a result, what emotions did you experience from it. And this is going to be a starting point for Reynaldo to coach you and provide very customized and very specific step-by-step type of solutions to all of you. While if you want it this way, obviously we're going to keep those emails anonymous, so you will get your answers, you will know it's you, but we will not state the name of the person unless you happen to be live and you don't mind. Actually, you prefer that this is known as you because you want to interact, and of course, feel free to do so if that's your choice. Okay, but the bottom line is check your inboxes, and before tomorrow, go ahead and reply such email if you want to participate of those sessions. If you are not receiving the email, just respond that question to support@tradictiv.com. Okay, and then either attend live tomorrow the session with Reynaldo, that would be ideal. And if you cannot make it live, then watch the recording because your answer will be there since Reynaldo will be addressing all those questions to everyone who has sent an email. Okay, so again, I just wanted to use a little bit of today's time instead of talking about options, talking about this because it's very relevant, as it says here that trading experts, we all agree that trading psychology is a huge percentage of the trading game. Some people say up to 99%. I mean, I don't know the real figure or the exact or precise figure, but certainly it's a big thing. Okay, so feel free to comment if you agree it's a big thing. Feel free to comment, if you have anything to say or there's anything better we can do to help you, and certainly make sure that you answer that email so tomorrow you could benefit from the sessions better than simply watching solutions provided to others. You can also have solutions provided to yourself with your specific case. Okay, cool. Anyway, so how are you, my friends? Random pictures. How are you, Anil? How are you, Ahmed? How are you? How are you, everyone? It's really good to have you in the session. We're starting with 6 minutes of delay today, if you wish, because I was talking about that important email and tomorrow's session with Reynaldo. But again, it's time well spent because it's important stuff. Let's begin. As always, first part of our session when we deal with options is I will look at the S&P and the VIX, which is what I'm going to do right now. From there, we'll look at the trades that we have to be reviewed, which is a trade that we set up last week with Team. It was an iron condor. And then from there, we'll move into identifying new opportunities. Okay, so quickly, what's going on with the S&P? Well, the S&P is pushing up. Climate is thick and blue, so confirmed to the upside. This is candle number 7 out of 10. So there is indeed room for the market to keep pushing a little higher. If it drops, the UFO will tend to push it back higher. So very likely we're going to surpass that point and start making all-times high again. And very often what happens is that we got a little bit of fatigue and then it retraces and does some sort of a correction, goes to the next UFO and starts again, right? So again, that would very nicely coincide with, going from candle number 7 to candle 10, 11, something like that, and then having some sort of a correction. So I could see that happen. Again, we'll react to what's happening. And my job as a trader is not to predict. Okay, that's not what we do. We just execute trades based on rules and processes. But certainly the stats that AutoClimate provide would suggest, together with the UFOs we have on the screen, would suggest that something like that could certainly happen. Okay, so we'll see it happen and react to it as AutoClimate and AutoUFOs gives us permission. Okay. In the other hand, by looking at the VIX, we could understand better the prices of options. Okay, and what's happening to the VIX today is that it's dropping a little bit. The VIX is dropping into a green UFO, so you would expect a little bit of a bounce. Okay, but again, that would mean a little bit of a correction of the market. And if the market corrects and drops, the VIX will go up. But guess who is here? A red UFO, likely going to bring the VIX go down again, which again, it's very much in line and in tune with the comment I just made about the S&P making another all-times high soon enough. Okay, so we'll see if that's the case or not. In any case, a good one when it comes to the trade that we put together last week. So last week, last Thursday was what day? It was the 7th. So if we look at the 7, that's more or less here. And we were dealing with a VIX trading around 23, right? Today the VIX is trading around 22. It went down. So while it did go up a little bit, okay, and there was a time where the VIX went against us during the trade, finally it went in our favor. And on top of that, of course, we accumulated time decay. So I'm about to move into TIM, which is the trade to be reviewed, and which is the trade that we put together last week. And this is certainly a trade that is, let me load OptionStation Pro, but it's certainly a trade that is doing what we were expecting it to do. The stock is in the purple area. We were expecting from January 7 to January 15, which is tomorrow, which is the expiration date of the options that we selected. We were expecting the stock to remain trading between 248 and 215, and that's what's happening. Okay, so what do we have here? So let me go ahead and actually I could look at this trade with Tim on the Manage tab. Okay, and you can see that this trade is providing a profit right now. If you were to look at the current level of premiums for that condor is 5 cents, meaning that basically anything that could have been collected had been collected. The only bad news here is that, the spread has widened as a consequence of that stock not being that liquid, and the fact that we are approaching expiration date and we are so far away from those strikes. So liquidity is really, going away from those further away strikes, and then closing the Iron Condor manually would probably imply a little bit of pain, because you will need to, maybe pay a bit too much to get out, plus pay commissions. So given the fact that tomorrow is so close, given the fact that statistics would suggest that from today until tomorrow expiration, the most that stock should move, and again, should means, based on probabilities, it doesn't mean it's going to be there's the sure thing future. There is no such a thing, but the stock should stay between 234 and 222, where if you look at the chart, 234 is more or less here, 222 is more or less here. So in other words, certainly we should be above 215 and below 248 into tomorrow. So, really I would not suggest closing the trade. If you are in the trade and you didn't close it already, I would just let it be and wait until tomorrow's expiration. Again, there are dynamic ways on how to deal with iron condors. We talked about this in prior sessions. There are many things that could be done. One typical technique is that once you enter an iron condor and you let time pass, and there is a moment in time where you could close the trade for half of the credit collected, you could go ahead and close it. We passed that point by a lot already. So that's why I'm suggesting that, given the fact that we got the UFOs to defend ourselves, and statistics suggest the stock to remain within the purple area, and there is actually a lot of wiggle room for us to be wrong on that. So if you haven't closed the trade, I would say that the smart approach would be to leave it alone and wait until the options expire, and you would have made that whole profit. Okay, so trade is looking good. Hopefully you guys benefited last week, not only from the learning experience, but you are also executing and practicing this trade. It's not too important to me, if you are practicing the trade with paper money or real money, or smaller size or larger size. All of those are your decisions, obviously. But apart from seeing it on the screen, certainly if you are in learning stages, I would definitely point at the benefits of using a demo account, where you could see that time decay helping the trade. As you can see on mine, I executed this trade in a paper money account. As you can see, it's a simulated account here, which I'm using. And you could see that, by the way, you probably remember that I took this trade with a market order, which I said, never do that with an iron condor. You always need to use limit orders and shift the spread, isn't it? But I took this trade with a market order. Still, notice how the trade is in profit. So in other words, I got huge pain with the worst price ever, and still the trade is in profit. Why? Because we are 1 day away from expiration. So we basically collected all that beautiful time decay, where even if the VIX had moved against us, the trade would be very likely in profit as well. Okay, so because we are so close to the expiration date. So again, all of those subtlenesses of trading options are more easily understood if you have the trade in the market instead of if you only watch the chart. Okay, again, I try to be as visual as possible with the chart, with the purple area, all of those things. Hopefully that helps, but certainly I'm counting on you guys to add some practice on your own when the sessions are over, other days of the week. I'm counting on you guys to put some time and effort into practicing what you learn with me on the channel, because if not, I am kind of limited on how much I can help you. And that's also how you guys will develop questions that then you can bring to me or to my colleagues in the channel, and we can help you with answers. Okay, cool. So not much more to say about this trade. I see a question in the chat box, so I'm just going to take a look, and then we'll move into planning new trades for the day. How are you, Formon? Good to see you, my friend. Cheerwild, just in principle, why don't you put stops on iron condors for when a loss is starting to be equal to the premium received when you put on the trade? Well, the reason why is because for you to have a stop loss on an iron condor, and when the stop loss is triggered, for you to get the amount of pain you expect to get, you will need that contract to be amazingly liquid and your strikes to not to be too far to remain liquid, because if you get stopped out on the call side, typically the put side is going to be far away, or vice versa. So when your options are not so liquid, or your strikes are really far away, and therefore when stopped out on one end, the other end is so far out of the money, and therefore you have no liquidity, what typically happens is that you get lots of slippage. So you were expecting maybe to get a loss of, let's say, $100. I'm just picking a round number. And then you get stopped out, and then you look at your P&L and it's like, what just happened here? I lost 170 plus commissions. And it's like, what happened? Well, you just got hit on slippage big time. Okay. So the approach that I'm having in the YouTube channel, since we are conducting very short 45-minute sessions here, my approach is, let's call it simplistic, in the sense that I'm just setting up the iron condor and closing my eyes and wait until the expiration date. Certainly, there are better ways on how to deal with the iron condors, and we had discussed in the past alternatives such as closing the trade manually, not when you're stopped out, but when you're somewhere in the middle of the range and you have collected enough premium based on time decay. Because when price is in somewhere in the middle of the range, you don't get that much slippage, because first, you are not so close to expiration. Second, you are not that far from the strikes because you are still in the middle. So then liquidity could be okay, or it's easier to get good prices, and you do it manually, not with a stop market order. So you do it with a limit order, and then you can shave your way out of the condor. And normally it's a healthier approach. That's, of course, if the trade is working well for you. If the trade is moving away from you and not working well for you, then what we have discussed in the sessions as well is to reconvert iron condors into iron butterflies and do some sort of remodeling of the positions. What I used to call, that's the way I like to call it, because it reflects very much what it is. I like to call it damage control. Meaning that you cannot, some people out there in the industry talk about the concept of repairing trades. That gives you the false impression that you take a loss and you make it a profit. That normally is not the case. I like to call it damage control, because you take what was going to be a loss of a certain size and you reconvert it into something which is controllable, where you don't get killed on slippage, and now basically you give the trade an opportunity to profit again, which is not so likely to happen, but it could. And if you were to end up in a loss, you basically took the initial loss and you made it much smaller. And that's why I call it damage control. So again, there are recordings on the YouTube channel where I talk about that. You could go ahead and look at the playlists and look for damage control, and you will see it. And that hopefully helps you to open your eyes. Again, not a fan of using stops. If you were to do it with iron condors on the SPY, for example, which is super liquid, so then you could do it. It should work. But at the same time, doing iron condors on ETFs would normally not pay you that much, because they are ETFs and the premium built in is less. So no matter how you look at it, it's not that amazing. And the iron condors that pay you the most often are stocks that are not that amazingly liquid. Okay. So long answer to your question. Your question is very good. Very good. Your question is the recipe of major troubles out there. Again, using my made up numbers earlier, I said, let's say you were expecting $100 of loss, and then you get stopped out and now you lose 170. That's 70% loss additional to your initial plan. That's crazy. You almost doubled the amount of money you were planning to lose, right? So I made up those figures, but let me tell you that this is a normal thing to happen to stocks that are not so liquid as expiration approaches, and therefore you lose liquidity. And by the way, you guys, the ones of you with more experience, if you have traded iron condors and you put a stop and you got killed on slippage, feel free to comment on the chat box, because it's good feedback for the community. And you guys, if you are newer to trading options, that could certainly open your eyes, and most importantly, avoid big troubles, to happen to your account. Okay. Very nice. Marie, how are you? Good to see you, Marie. A pleasure to have you. Anyway, so let's begin planning our trades, guys. And as always, the way I go is I use the scanner. We got directional trades on the top, and non-directional and neutral in the bottom part. Again, if you look at what the scanner is giving us, not too many directional opportunities. Why? Options are not cheap. While the market is clearly in an uptrend about to make all-time high, options are not cheap. So not the best time to do a directional trade, at least today. To the downside, no opportunities at all. Why? Well, number one, options are not cheap. Second, the market is in an uptrend, a clear one, making all-time highs. So very, very few stocks are in a downtrend. And if they are in a downtrend, people are going to be scared, and a lot of people already bought options, inflating the prices, and therefore options are not cheap, which is the first thing I said. So few opportunities to be directional. We could certainly look at those three later on, but because we got more opportunities as non-directional trades, because there is more statistical advantage, that's the beauty of the scanner. Again, it's not a guarantee, but I mean, we see it working well with TIM, right? So why don't we try to replicate that again, right? Let's not fight it. Let's adapt to what the market has to offer. And the beauty of the scanner is that it kind of reveals what's available. Okay, and you may be a fan of directional trades and you may be like, oh, I don't like this scanner because I want more opportunities. Well, yeah, but you would have less statistical advantage, right? So the beauty of being guided by the scanner is that the scanner is kind of revealing to us where the quality is, right? And right now, today, the quality is on the stocks in front of us. So let me sort it based on their price. I will ignore Google. Okay, why? Again, it's a fantastic company and a fantastic stock to trade, and actually pretty okay options too. But it's a pretty high price point, and my assumption in the channel is always that a decent amount of you guys are probably in learning stages, and if that's the case, and that's why you are attending those sessions, probably you want to practice those trades and take it easy with the size. And of course, if I give you trades that are amazing, but your account cannot utilize those trades because your account is of a smaller size, or maybe your account is humongous, but because you are new to trading or newer to trading, you decide to take it easy with risk management. Well done, by the way, if that's your approach. And therefore, you limit yourself on how large of a risk you can take. And therefore, again, Google will not be a good candidate for that. Okay, so while it's a good candidate to trade, I'm going to skip it and I'm going to start with now. Okay, and let's see what now has to offer. And I'll take a sip of water if that's okay. Very good. So service now is loading. We got 50% probabilities, okay, which is fine. Today is January 14. So next expiration date is on the 22nd, right? Next Friday is on the 22nd. And why am I pointing at this? Well, because when we look at the earnings for now, they are pointing at January 27, which January 27 is happening on the week after January 22nd. So in other words, we do have what we need in order to take a look at an iron condor on now, utilizing January 22 expiration date. We cannot use 29 because that would surpass the earnings date, but certainly we can use 22nd given the fact that earnings would happen after our trade is concluded. Okay, so looking good. Also 50% is good. Why? Because for non-directional trades, our rules, at least the rules I use, you may have a variation of the rules, fair enough, but my rules would be minimum 48% for me to accept the trade. So in this sense, 50% is more, so that's good. And if I look at pre and post market, let's see what happens. We got 37%, so that is not acceptable, and therefore this is market data that I will ignore because it's not producing or providing relevant or a statistical advantage. So I'm just going to focus on the regular session data for now. For the stock now. Now. Very bad joke. Anyway, I love bad jokes, by the way. So what I'm trying to say here is that we have a potential opportunity with that stock. Careful with this, because other stocks may give you the opportunity using pre and post market data, and you will ignore the regular session data. But with now, the relevant information is regular session, and that's the information I'm going to use. Okay. Now, I only have one problem, which is if I look at the current price of that stock and I project it to where the second UFO below is, okay? And why the second UFO? Because again, another rule I use in my trading is I always want to have at least 2 UFOs above and 2 UFOs below. So below, the UFOs are further apart, and therefore I started from that calculation, and if I project that distance to the top, so notice that is showing to me that the UFOs I got on the top, if I was to use 2 UFOs above and 2 UFOs below, then it would put the current price very close to the upper part of the range. So I could certainly use 3 UFOs above, okay? And now the current price is still closer to the upper part of the range, but a bit more centered compared to before. But it's not ideal because I still got that particular distance here above, which is not covered by any UFO. So I'm not loving the setup. I'm not saying it's a setup to be discarded, but I'm not 100% in love. And therefore, what I'm going to do is I'm going to go check other possible opportunities, because I got more symbols, and I may find a setup which is more, let's call it purist. Oh, you were laughing at that one, Ahmed? I thought that was the only one laughing at that one. It was very bad, let's face it. So if you want to be a bit more purist, as I was saying, some other stocks in the list may give you a setup where price is more properly positioned in the very middle part of the range. And why is that important? Well, it's important in the sense that it's not critical, but it's important in the sense that you are giving yourself greater amount of room, okay, for price to either move either up or down before you are proven wrong, assuming that we don't know what's going to happen, okay, which of course with the UFOs and the climate, we could have a measurement of what's likely to happen, but you never know for sure, especially with stocks, because as I always say, stocks are fragile. And they are beautiful, and they are beautiful trading products to trade. But they are fragile in the sense that they depend on the sector, they depend on competitor companies, they depend on the broad market, they depend on the dollar index, they depend on so many things. And that's why I'm calling them fragile. So while they are right assets to be traded, they are fragile, and therefore we need to position ourselves as far as possible from a problematic situation. And ideally, you start at the midpoint of the range, so you are far from everything that we would call a problem, okay? And that's a good way to begin the trade and collect as much time decay as possible. So I'll leave now alone for now. Again, bad joke. And I will come back to that stock later on if I don't find anything better, okay? Again, I'm going to try to be a bit more purist in the beginning because certainly that helps, okay? What else do we have? We have Team. Team is a trade that we have running at the moment. So again, could I plan a new trade given the fact that earnings are on the 28th? So could I plan a trade using January 22nd? Oh, yes. The answer is yes, I could. But again, I already have a trade running. So if I was to enter a trade and you are also running this trade, you are kind of adding more risk into the same stock. So I would rather use another stock if possible. So again, Now and Team are 2 stocks I will leave for later in case I find nothing else, okay? UPS, let's take a look at UPS and see what we have. So UPS is giving us 54% performance stats. This is beautiful. If we look at pre and post market, it's providing 49%, so that's beautiful too because it's more than 48, so I could actually combine UFOs from pre and post market together with UFOs from the regular trading session. So again, that gives me a lot of flexibility. Plus, this is a very liquid stock with liquid options, so that's good. And earnings are happening on February 2nd. So again, in this case, I could use January 22nd I could use January 29 as well. So I could do an iron condor for a week or two, and that gives me potentially more options. Okay, so I'm gonna take a look at UPS. Okay, I'm excited to put together a trade on UPS and see if we end up with a go ahead or we end up with a no go. We'll see what's gonna happen depending on the other rules that we have in our method. Lutfi, it's very nice to see you, my friend. Very, very, very joyful event that you join us in the session. Welcome, my friend. Anyway, so let's begin with the planning for UPS. And again, the first thing that we need to do is, without thinking, because we don't want biases. So the first thing I'm going to do is I'm going to load UPS. Okay, and I'm going to pick the nearest expiration date, which we said is going to be January 22nd. And without even thinking, as I said, I'm just going to right-click anywhere randomly to analyze and sell an iron condor. And the reason why I keep saying don't think is because right now I'm not interested in any biases or anything like that. I'm not interested in strikes either. I'm only interested in making sure I selected the right date and looking at what one standard deviation above and below is to have a reference point on my chart from where to begin the planning. So we are talking about 171 and 158. Those are my reference points, and therefore I'm just going to go ahead and draw a dotted line at a, what did I say? I said 158, I believe, right? Yeah, 158. Yes, and 171. Okay. So 158 is there, new parallel, and then I'm gonna move this to 171, more or less here. So those are my reference points, okay? And with this in mind, what am I looking for? Well, I'm looking for UFOs above and below. Here I have one, here I have two, okay? But while they count in the sense of count, they are not valid in the sense that they are not beyond the dotted line, okay? So my first UFO beyond the dotted line will be this one, and certainly that will be UFO number 3, which is good because it's 3, which is 2 or more, and is beyond the dotted line. Below, I have UFO number 1, okay? I have UFO number 2, and that UFO number 2 also works because it is indeed beyond the dotted line. So in that sense, all of this is good, okay? Now, I also want to check the regular session because we got more data there, isn't it? And notice that if I look at the regular session, I got more stuff, right? Because now this is UFO number 1, which coincides with the UFO we found in the pre-post market data. This is UFO number 2 below, which also coincide with pre-post market data. So it seems that 157 something is indeed a valid price point for us to select. And on the upper part, notice that now I have another UFO, which is UFO number 1. Then I have UFO number 2 here that coincides with the one we had already, UFO number 3 that also coincides with the one we had. But now, notice how UFO number 4, okay, which is beyond the dotted line, would be this one at 172. So I don't need to go that high. Actually, the regular session data is indeed providing more UFOs. So now, if you measure the vertical distance from the current price to that selected UFO, oh, I just deleted the wrong line. Sorry for that, guys. So if you were to measure the vertical distance from the selected UFO to the current price above, right, and I was to duplicate this line, and I was to project it below, right? So notice how now there is a little bit of an extra here. This tiny, tiny, tiny. I mean, if you compare that with what we see with now, it does seem that UPS, it's not exactly perfectly centered, but again, that perfection is almost impossible to find, but it's definitely much more centered than what we saw with now earlier. So definitely happy to go ahead and continue the planning of the trade with UPS. And therefore, my next question is, okay, how much do I get paid if I sell 172 calls? Because I'm going to have to sell calls above 172. I'm going to have to sell puts below 157 or 158. So the question is, how much I get paid for the 172? And it's probably going to be 172.5. So let's take a look. And yes, indeed, it's 172.5. And notice how the 172.5 pay us 42 cents. And that meets our rules. Why? Because the first rule we have is that the options that we sell need to pay us at least 35 cents. okay? And this one is paying us 42, so it's good. Then on the bottom part, we are looking for 158. There is no 158, but we do have the 157.5. And notice how the midpoint, okay, it's 89, okay? And oh no, sorry guys, I went to the wrong one. It's 52. I was like, that's not possible. So it's 52, and 52 is indeed also above 35 cents. So far, my friends, looking good. If we sell the 172.5 and we sell the 157.5, in both cases, those options provide 35 cents each of them. Okay, so this is looking quite good, really, for the trade to be approved. It's not a sure thing yet, but because it's looking pretty good, I don't feel it's going to be wasting our time if I do some writing on the chart. So I clarify and define the trade better, and then you guys can also take a screenshot, okay? So it seems that we're going to be buying the 175 on top of the 172.5 that we just saw. So we would sell, minus sign is to sell, plus sign is to buy. So we would sell the 172.5 call, buy the 175 call above. All of this would be done using Jan 22nd expiration date. Okay, and in the below part, it's looking like, based on what we saw, that we will be selling the 157.5 put and buying below the 155. Okay, this will create a trade which is known as an iron condor, which is well balanced in the sense as the strikes are lining up with our final UFOs above and below, and the strike price increments, the strike price difference, I should say, between the strike we buy and the strike we sell is $2.5 above with the calls and $2.5 below with the puts, meaning everything is well balanced. Okay, so let's put this together on our analysis tab and see if we get an approval for the trade. We are about to find out if the trade will be approved or not. 55 and 57.5. So let me review and confirm what I said is correct. So 75, 72.5. Yes, on the call side. And then we got 55 and 57.5. Yes, on the put side. Okay, so again, put side 155, 157.5. Call side 172.5, 175. The trade is set up properly, and it seems that if we were to do it this way, we would collect, or we could collect up to 36 cents of premium. So the question is that a trade to be accepted? Well, the raw risk of the trade is $2.5. Okay, if you're newer to the sessions, what is the raw risk? The raw risk is the distance between strikes, which is $2.5. Okay, that's the raw risk. What's our rule? Our rule is to collect at least 15% of premium out of what the raw risk suggests, and that's 37.5. In other words, $38 per contract, 38 cents. What are we being paid right now? 35. So is the trade approved? No. We need 3 more cents for the trade to be approved. 15% of the raw risk, Ahmed, which is the distance between strikes. You may want to call that the spread, but make sure you understand it's not the bid-ask spread. It's the spread between strikes. So I rather call this the raw risk to avoid confusion. But again, I could understand you could call that the spread. It will be fine, okay? So you look at your worst case scenario, that's the raw risk, $2.5. You want 15% of that, okay? So in other words, we are being provided by 36 cents now. We need 38 cents to accept the trade. So is the trade approved? No. Okay, by 2 cents. It's a shame, but that's trading, my friends. The trade is not approved. Now, does it mean that, we just quit the trading day today and there is nothing to do today? No. Apart from the fact that the list of stocks is longer and we could certainly look into other stocks and we may have an opportunity. Last week, the trade with Tim was found at the very last minute of the session. You may remember that. So we could certainly do that. But at the same time, what you never know what's going to happen is that what's going to happen in the marketplace. So maybe, some new news comes out, talking about, I don't know, maybe the Trump and the impeachment, or anything. It doesn't matter if it's a good news or a bad news, or you believe in it, or you agree or you disagree, or what. If the news spices up the market a little bit, scares people a little bit, next thing you know, you may have a peak of demand for options buying. Next thing you know, that 35 cents that we see now in the midpoint becomes 42 cents. And next thing you know, now you get your 38 cents. But of course, you don't know if that's going to happen or not. And if it happens, it may happen and last for 5 minutes and then it's gone. So how do you take advantage of that? Well, you take advantage of that by placing an order using a day condition. So let me do it. I'm just going to select trade. Okay, so I'm going to assume I want to take this trade with one contract, which, by the way, if the raw risk is 2.5 and you get filled at 38 cents, that means that the risk of the trade would be $212 per contract. So if you do this trade with one contract, you're risking $212 plus your commissions plus potential slippage. If you are doing that with two contracts, is double, three contracts is triple, etc. Okay, so let's assume that you're okay with that and you want to take the trade. So what would you do? You would come here and make sure your credit is at least 38. To be honest, I would prefer to go for 40. And then make sure the type of trade, the type of duration that you have selected is day, meaning that if you place this order and you get filled during the day, great. But if you place this order and you don't get filled during the day, then the order will be automatically erased from your account at the end of the trading day. And tomorrow this trade is not there. So you could go ahead and reassess, and maybe the trade is not valid anymore, so you cancel it. No need to cancel because it's gone at the end of the day, but you can always replace it if the trade is valid. Maybe new UFOs form, maybe you have another way to set up the trade using other strikes. So again, you will need to review the trade tomorrow. Okay, that's why I suggest to use a day type of order. Also, because some brokers, including TradeStation, charge you for cancellations. So if you were to use a good till cancel order, and then tomorrow you want to cancel the order, then you will need to pay just a few cents for cancellation, but you will need to pay. Where if you use a day order, you already stated the order is day. So the order is automatically canceled for you. And because it's a day order, it does not imply cancellation charges because there is no cancellation. It's just the order expired at the end of the trading day. Okay, so it would be fine to do it like that. Okay, so this is exactly what I'm going to do. Okay, so I got my 40 cents here, limit order, they only, and I'm just going to place the order. Okay, click yes. Okay, and if you were to do that, you just review all is good. I'm going to assume all is good. Click yes, and then you will move into your manage tab, and here is your Iron Condor on UPS waiting to get filled at 40 cents with a day order type. And we are just waiting for that, whatever happens out there in the world, and we have a little bit of a peak of volatility, options increase, you get filled at 40, and you are a happy trader. And if it doesn't happen, so be it, because the trade is not to be taken the way it is right now, since it does not meet our 15% rule. Again, could you have a different rule than me? Yes, of course. Would it be wrong? No. As long as you have back tested it, you know what to expect, you are okay with the results, it's part of your trading plan, all of this, so then it's fine, okay? But if you haven't done that, then careful, because, I would then, understand that you are just taking a little gamble there, and that, my friends, is not a serious thing to be done, and certainly I will not teach you to do that. I will teach you to be disciplined, to be mechanical, and to be professional, okay? So what I'm doing here is I'm just drawing, as always, the beautiful purple area where we expect the stock to remain in. I'm just going to add UPS here on my to be reviewed list. I will add a white space in between, though, because we haven't been filled. So it may be a trade to be reviewed out of curiosity, but it may not be a trade because I haven't been filled yet. Okay. So if you guys are going to be executing this trade either with paper money or real capital or whatever, so next week we could certainly comment on that, and you guys can share with me if you got filled or you didn't. In my case, I am very unlikely going to get filled, and the reason why is because I am using a simulated account. You saw that here, okay, on the YouTube sessions. That's what I do, and with a simulated account, at least the way it works with TradeStation, And I wanna tell you a bit more about that. We will conclude the session with this comment. It's important for you to know if you don't. With the simulated accounts with options, some brokers always get you filled at the midpoint. For example, TD Ameritrade, Think or Swim. No matter the trade you take, you will get filled at the midpoint all the time, which is not realistic. It's too advantageous. In the real world, it's not like that. Especially if you trade a large size, you will not get filled at the midpoint. But if you simulate your trades with a platform such as TD Ameritrade, you would always get filled at midpoint. Okay, so you have to be careful with that expectation there. Okay, with TradeStation, the guys are too realistic, if you wish, because they will never get you filled with a limit order on the demo account. They will only get you filled with market orders, meaning that they give you the worst price. So if you sell, you get filled at the bid. If you buy, you get filled at the ask. It's the worst price ever. So it's kind of like going to the gym and training with weights. In the real world, you could indeed get better prices than that, but not in the demo account. So it's kind of like you're training with weights. So not a bad practice. Actually, it's good. At the same time, sometimes it will avoid you the practice. Like it's likely to happen to me, where in the real world, if we have a peak of volatility, you could get filled with real prices at 40 in the simulated account. Even if it goes to, let's say, 45, I won't get filled because it's a limit order, and limit orders don't fill for options with TradeStation in the sim accounts. For futures, for other assets, no problem, but not for options. Okay, so just something for you to know, which kind of makes sense that TradeStation decided to do it this way, but for practice purposes, it's a bit problematic. At the same time, other platforms give you a false impression of profits, where in the real world is not the case. So just know that there is no right or wrong. Options are by definition an asset with much less liquidity than other products, and therefore there is no magic formula on how to simulate the real market. There is no way to simulate the real market unless it's real trading. So I'm talking about the real bid, the real ask, the real bid size, the real ask size, the real fills. Okay, that's in options is not possible. So just keep that in mind for you guys that are in practice mode. Okay, cool. With all of this said, we are reaching the end of the session, guys. So we'll see. We'll talk about it next week. If you guys got filled on this trade or you didn't, and how did it go? Again, hopefully the session was informative and provided value to you guys. If it's the case, great. That's my intention, and I would appreciate a thumbs up on the YouTube channel. All those things that are commonly done when people are happy with what you see online. But most importantly now, if the sessions are not providing the value or what you need, and we're not supporting you the way you deserve, make sure you speak up. Okay, shoot an email to us. I mean it. Let us know. Hey, Jose, you know what? In the sessions, I'm missing that you guys do this or do that. I love to see this or do that. And we can even at times conduct a special session or whatever is needed, guys, to help you and assist you on your development and the use of the apps and everything you do in trading in general. Okay, guys. So count on us. We're committed to you guys, my friends. But that also implies that you need to be committed to yourself, in the sense of putting time and effort, and even crafting an email, like what I said earlier at the beginning of the session. So tomorrow we can talk about trading psychology or any other thing that you may need to discuss. Okay, so here's the email, by the way, the one I was mentioning before. So anyway, everybody, super pleasure as always. You guys take care. Keep up the good work as always. Love the interaction. See you soon. Bye-bye, everybody. See you next week. Bye-bye.